The finance industry is often described as the engine that drives the global economy. Banks provide loans to businesses, investors fund innovation, and financial markets supposedly create wealth for everyone. But here's the uncomfortable truth. While finance has the power to fuel growth, it also has a long history of destroying economies. From the Great Depression of 1929 to the housing market collapse in 2008, and even the debt crises faced by countries today, one thing is clear: unchecked financial power can devastate nations and ordinary people. Behind the headlines of market crashes and bailouts, there are real human costs: lost jobs, ruined savings, broken families, and countries stuck in cycles of poverty. In this video, we'll explore 4 key ways the finance industry destroys economies. These aren't abstract theories, they're patterns we've seen play out again and again. By the end, you'll not only understand the mechanics behind financial crises but also learn how to protect yourself from them. The 4 destructive forces are: 1. The illusion of growth created by financial bubbles. 2. The use of debt as a weapon against nations, companies, and individuals. 3. The prioritization of speculation over real production. 4. And finally, the system of privatizing profits while socializing losses. Let's break these down one by one. Keynote 1. The illusion of growth. Financial markets thrive on the appearance of growth. Rising stock prices, booming real estate markets, and record corporate profits are all celebrated as signs of a strong economy. But appearances can be deceiving. Often, this growth is built not on solid fundamentals but on speculative bubbles. A bubble occurs when the value of an asset, like housing, stocks, or even cryptocurrency, rises far beyond its true worth. Investors pile in, driven by greed and the fear of missing out, pushing prices higher and higher. For a while, it looks like everyone is getting richer. But in reality, the foundation is unstable. Take the 2008 financial crisis as a prime example. For years, banks aggressively promoted subprime mortgages, home loans given to people who couldn't realistically afford them. These risky loans were bundled into complex financial products, sold globally, and given high ratings by agencies that should have known better. For a while, housing prices soared, and the illusion of endless growth kept money flowing. But when reality set in, when borrowers couldn't pay back their loans, the entire system collapsed. The impact was catastrophic. Trillions of dollars in wealth vanished, millions of people lost their homes, and global economies fell into recession. All because the finance industry prioritized short-term profits over long-term stability. This illusion of growth isn't limited to housing. We've seen it in the dot-com bubble of the early 2000s, where tech companies with no real business models were valued in the billions. More recently, speculative frenzies have occurred in cryptocurrencies, meme stocks, and commodities. Each time, the story is the same: the finance industry fuels unsustainable growth, and when the bubble bursts, it's ordinary people who suffer most. Why does this keep happening? Because financial institutions benefit from the boom while shifting the risk of collapse onto others. Bankers earn bonuses during the rise, investors cash out at the peak, and when it all falls apart, workers, taxpayers, and governments bear the losses. The illusion of growth is dangerous because it creates a false sense of security. People believe their homes, retirement accounts, or investments are safe when, in reality, they're sitting on a ticking time bomb. The finance industry knows this, but as long as profits keep flowing, the system continues, until it crashes again. Keynote 2. Debt as a weapon. Debt is often sold as a tool for opportunity. A mortgage helps you buy a home, student loans help you get an education, and government bonds fund infrastructure. In theory, debt can be productive. But when misused, it becomes a weapon, one that traps individuals, businesses, and entire nations in cycles of dependency. At the personal level, credit cards and payday loans are marketed as conveniences. In reality, they lock millions into high-interest payments that they may never escape. The finance industry profits enormously from late fees, penalties, and compounding interest. Instead of empowering people, debt becomes a shackle. At the national level, the story is even more alarming. Many developing countries have taken massive loans from international institutions like the IMF or World Bank, often under pressure. These loans come with strings attached, strict conditions that force governments to cut social spending, privatize public services, and prioritize debt repayment over their citizens' needs. This process, known as structural adjustment, has left many nations weaker, not stronger. For example, several African and Latin American countries have been caught in debt traps for decades. They borrow to stabilize their economies, but the repayment terms are so harsh that they end up borrowing more just to service old debt. The result: perpetual dependency, stunted growth, and economies that serve creditors instead of their people. Corporations face similar traps. Companies often take on massive debt to finance mergers, buybacks, or expansion. When times are good, they can service the debt. But when downturns hit, debt repayments become unbearable, leading to layoffs, bankruptcies, or government bailouts. The finance industry thrives on this system because debt guarantees steady income. Unlike risky investments, debt repayment is contractual. You must pay, even if it ruins you. And if you default, creditors often seize assets, further enriching themselves. This weaponization of debt turns economies into machines that transfer wealth upward, from workers and taxpayers to bankers and creditors. It creates inequality, instability, and cycles of crisis that are hard to escape. Keynote 3: Speculation over production. At its core, an economy should be about producing goods and services that improve people's lives. Factories, farms, and technology companies create real value. But over the last century, the finance industry has shifted focus from production to speculation. Speculation means betting on price movements rather than creating something of value. Traders bet on currencies, commodities, interest rates, and even future disasters. The problem isn't speculation itself, it's the sheer scale. Today, the vast majority of global financial activity is speculative, not productive. For example, the derivatives market is estimated to be worth hundreds of trillions of dollars, many times larger than the world economy itself. Yet much of this trading doesn't fund businesses or create jobs. It's financial institutions gambling against one another, extracting profit without producing value. The 1997 Asian financial crisis is a case study. Hedge funds and speculators bet against Asian currencies, triggering massive devaluations. Economies that had been growing rapidly were thrown into chaos. Millions lost jobs, and decades of progress were undone, all because of speculative attacks by powerful financial players. Meanwhile, productive sectors, manufacturing, agriculture, infrastructure, often struggle to secure financing. Why? Because speculation offers faster, higher returns for financiers. Why fund a factory that produces goods slowly when you can gamble on currency movements and make millions? Overnight, this imbalance drains resources from the real economy. Workers lose stability, businesses lack investment, and inequality grows. In short, when speculation dominates production, economies weaken. Keynote 4: Privatizing profits, socializing losses. Perhaps the most infuriating way finance destroys economies is through a system where profits are privatized, but losses are socialized. During boom times, banks, hedge funds, and corporations reap massive profits. Executives earn bonuses, shareholders see dividends, and investors celebrate. But when the system crashes, often due to their own reckless behavior, the losses don't stay with them. Instead, governments step in with taxpayer money to bail them out. The 2008 financial crisis made this painfully clear. Major banks created toxic mortgage-backed securities that nearly collapsed the global system. When it all came crashing down, governments poured trillions into bailouts. Ordinary people lost homes, jobs, and savings, while the very bankers responsible walked away with golden parachutes. This cycle creates what economists call moral hazard. If financial institutions know they'll be rescued, they have every incentive to take bigger risks. Heads, they win. Tails, the public loses. We've seen this repeatedly. The savings and loan crisis in the 1980s, the Asian crisis in the 1990s, the global crash in 2008, and even pandemic bailouts in 2020. Time and again, losses are shifted onto the public while profits remain private. This system erodes trust in both finance and government. People see that the rules aren't fair, that risk is rewarded for the elite but punished for everyone else. Over time, this undermines democracy, stability, and social cohesion. The finance industry isn't inherently evil. When it functions properly, it connects savers with borrowers, funds innovation, and supports growth. But history shows us that unchecked financial power often leads to destruction. By creating illusions of growth, weaponizing debt, prioritizing speculation, and shifting losses onto the public, the finance industry repeatedly destabilizes economies. The costs are borne not by the elite who cause the problems but by ordinary people, through unemployment, inflation, lost savings, and reduced opportunities. So what can we do? First, we must understand the system. Financial literacy is a form of protection. The more you understand how money and markets work, the less likely you are to be caught in their traps. Second, we need accountability. Banks and financial institutions must be regulated to prevent reckless behavior, and bailouts should come with real consequences. Finally, as individuals, we must think like the 1%, not in terms of exploiting others, but in terms of protecting ourselves by building assets, avoiding bad debt, and investing in growth. The finance industry may never stop chasing profit, but you can stop being a victim of its cycles. By learning how the system works, you take the first step toward financial independence and resilience. So, the next time you hear about a financial boom, a new loan offer, or a market opportunity, ask yourself, is this real growth, or just another trap? Because history has shown us that when the finance industry destroys economies, it's the people at the bottom who pay the highest price.